This is the Retirement Solution Podcast with financial advisor Jon Hicks, founder of J. Hagan Capital.
You have heard about Roth conversions, an effort to reduce your future tax obligations. But when is the time to do it? Is the question so many savers have. And that's what you, Jon Hicks, are here to help us understand. I'm Heather Branch. This is Jon Hicks, financial advisor, founder of J. Hagan Capital, here to share with us the how-tos in this conversation of the Roth conversion situation. The conversation about Roth conversions. Oh, by the way,
Sure.
retirementsolutionshow.com is our website, where to go to learn more about Jon and his team and begin that conversation. We also have links posted in the show notes. But the conversation around Roth conversions has been such a hot topic for probably the past 5 years.
Pretty much, yeah.
Past decade.
The very tail end of Trump 1.0 is when it started to be talked about, when they started changing a little bit of the tax regulation.
Okay,
yeah.
Got it. So, whether or not you know, required minimum distributions are coming for you, RMDs. It is the IRS taking its share of your savings. So if you have done the hard work, you've done the Lord's work, you have saved to your 401k or TSP or some other type of pre-tax retirement account. When Uncle Sam wants to take his share is, according to Uncle Sam, I'm sure not soon enough, but the law has it written at 73 years old is when you're forced to begin taking your RMDs, your required minimum distributions. One way to possibly lower what you will have to pay in taxes is to convert a portion of your pre-tax money to a Roth and pay taxes now. But again, when do we do that? So this is Morningstar's Christine Benz and her thoughts on the process.
Retirement planners often say that post-work, pre-RMD, pre-age 73 now is a real sweet spot to consider those conversions. And the key reason is that you have a lot of control over your taxable income in those years. They may be kind of the high spending years of your retirement, but if you can curtail how much you're spending, how much taxable income you have, that means that you can convert portions of your balance at a lower tax rate. So that's why it's a terrific window to look at potentially doing some conversions in that particular period.
The fight against taxes, I know, is one that it is a torch you carry, sir. So
it's one of those things where when you realize in the state of this union, this country that we have, if you do better, you often get taxed more, right? And so to me, it's just one of those things where, hey, you know, I can understand that. When you pay your fair share, it goes from essentially 10% all the way up to 40. So, you know, when you're moving up that ladder, that fair share becomes a little bit bigger. So it's one of those things, especially because I watch retirees every day. They have done the hard work. They've done their job. They've put the money away. They sacrifice from spending, sacrifice from all these things they could be doing simply because they're trying to save money. And then when it comes time for them to retire, what they realize is there are very few places to hide from the tax code. They're looking at themselves going, oh my gosh, Jon, how come I have less income? But because of the way that I'm pulling out my income, I'm actually paying more as a percentage of what I'm spending in taxes. I'm like, I know. And unfortunately, it's just one of those things. And RMDs is one of those things that can really sneak up on us, because everyone at this point in time has probably heard the conversation or the idea of maybe you should do Roth conversions. But some CPAs are out there, some tax attorneys are saying it's not a great idea. Other advisors are thinking it's the greatest thing that you could ever do in your life. And for me, it comes down to one simple thing. If your objective is to pay the least amount of taxes over the course of your retirement, which I think is a noble cause, it means that you're being a great steward of your money. You've saved the right amount and you want the rest of it to not go to the government. You'd rather it go to your beneficiaries, your kids and grandkids and the churches and the civic organizations that you support, right? And so it's hard to do that if the government, quote unquote, confiscates that. So in my opinion, one of the greatest things we can do is find, if our retirement's going to be from 20 to 30, I mean, we're seeing anymore, maybe even 35 or 40 years in length, we want to pay the least amount of taxes to the government over that period of time. Now, we're still paying our quote unquote fair share, but we're utilizing the laws the way they're written for us to pay the legal minimum if we can. Sometimes it involves Roth conversions. Sometimes it does not. Sometimes it involves much more sophisticated things, or if we're selling our businesses, or if we're selling a strip mall, or if we're selling a vacation home or an investment property. There are many things that many of us can do to fix things, but the one that I constantly see trip people up, Heather, is not understanding the taxes due on RMDs at 73, right? So one of the things that Christine just said, and she was exactly right, she basically said at some point in time, the government's going to come at you and they're going to say, hey, we're going to need you to pay some taxes on this. But there is a sweet spot that we should be considering conversions right after we've retired, but before we get 73. In a perfect world, between 60 and 68. Now, it just depends. If you're going to work until age 67, that only gives you 1 year to potentially convert before that age group. So it really just comes down to a 4-letter word that no one likes, but that's math, M-A-T-H. And we have to do the math on it to find out, does it make sense for you to convert? Does it make sense now? Does it make sense in the future? Because what I'm seeing, guys, and what a lot of the people out there are seeing, they're seeing a U.S. debt that is spiraling out of control. We've talked about it on the show many, many times. We have over $38 trillion of national debt now. We'll be getting close to $40 trillion by the end of 2025, going into January of 2026. Guys, we're getting very close to where there is going to be very little choice. Then the government's either going to have to cut some of the spending, which, let's be real, spending is not done on roadways. It's not done on NASA. The majority of the spending is in the form of Social Security, Medicare, Medicaid, and interest on the debt, right? That's it. So if the Fed decides to not lower rates quickly, they can't reduce interest on the debt unless we just skip a payment. And if we do that, we'll be a third world country. No joke. It's how it works. If you default on your payment, no one will want your bonds. And we then literally we have no value to our currency. So that won't happen. So what are they going to have to do? They're going to either have to raise more money, which means tax us more, or they're going to have to cut those social programs. Social Security, Medicare, and Medicaid. As we're getting closer to retirement, what do we really hope they have money in? Social Security and Medicare. I mean, those are two things we've paid in for a very long time. We're relying on them to produce a stability of income as a foundation. For most of us, it's either a pension or our Social Security. That's that stability. That's what allows us to do other things. And then we need Medicare, because if you don't have Medicare and you don't have corporate insurance anymore, if you've seen what it costs to insure our lives now, it is mind-numbing to me. In our firm, and we have great insurance. I mean, I can't say anything about that. We're going up 32% year over year, 32% year over year. And most of us are pretty healthy. Doesn't matter. That's just the stuff that's happening. So it gets very expensive. We need to save as much money as we can from taxation to offset these other issues. Otherwise, the government is going to come after us. So think about it this way, and then I'm going to get into the mechanics of what we need to do.
Okay.
If you got a 20% tax, I'm just making this up so we can all kind of follow the numbers. Okay. If you put in $10,000 in a tax deferred account, like your 401k or IRA, put in $10,000 over the years, and you got a 20% tax break, you got a $2,000 tax break, $2,000 on that $10,000 investment. Now, assuming that we work for 20, 30, 40 years, many times, if we just get a 7% rate of return, that $10,000 will have grown to potentially over $100,000 over the course of our working time. Those are just getting normal rates of return. This isn't crypto returns. We're not talking about getting lucky and choosing NVIDIA the day they were listed. Nothing like that. Normal returns. Now the government wants the same 20%. You're thinking, well, they give me a 20% break. Now I'm getting a 20%. Now I got to pay them 20%. Not a big deal. Well, ladies and gentlemen, you got a $2,000 break. But at $100,000, you get 20% on that's $20,000. The government's hitting us with an $18,000 difference on what we saved in the front end and what they're taking in the end. I see that potentially getting worse. Okay. So 2 things we need to do. You need to understand, should you convert? Well, it's a simple process of math. When do you want to retire? What other income streams do you have? Are you turning on Social Security early? Or are you playing the game that I like to do, which is what we call the 62-70 rule, where if you have different ages and you're a married filing jointly couple, we take the lowest earner and have them turn on their Social Security at age 62. Why? It provides an income stream. It provides a little bit of stability for retirement, but then the larger earner turns on their Social Security at age 70. Now, this is gaming the system as much as we're allowed to do anymore. There aren't as many loopholes as there used to be. But by doing that, we can potentially increase our total income from Social Security by 22 to 29% over time. That is some of the easiest money we're ever going to get if the math works. Should you convert? It's going to be based on if you're utilizing strategies like that. It's going to also be based on how much money you have in taxable accounts versus how much money in tax deferred accounts like our 401k or IRA. How much money do we have in real estate? How much do we have in investment properties? How much money do we have in Roth accounts or tax-free accounts? In a perfect world, every year we want our CPA or tax attorney or financial advisor who works with those, like we do it in my office. We have CPAs, tax attorneys, and financial advisors that are all literally trying to figure out how can this client do the best, not just this year, but for over the next 25 to 30 years, no matter what. It's a big one. If we do some things correctly, we can literally save hundreds of thousands of dollars. And if we're a good saver, this is not a joke. There was a couple that came in a couple weeks ago. They'd saved about $2.5 million, but they were going to retire a little early. They were only going to retire at age 61. I'm like, this is great. We got a lot of time to dismantle your tax obligations and put you in a better position. Once we went through the strategies that we would do to start looking at conversions, start looking at should we do Roths or should we do real estate or should we do trust work, we figured that even though they'd save $2.5 million, we were going to save them over $1.7 million in future tax obligations by getting the strategy right. Wow. Guys, those are real numbers, and that worked for them. Why? Because they have the retirement's a little bit different. They're retiring a little bit earlier, and they already had other assets to pay them. Okay. So the main thing to understand is if you're not taking advantage of tax strategies leading to RMD age, after RMD age, it gets a lot worse going forward. Doesn't mean that it won't work, but you got to think about that. If you don't have a skilled fiduciary that understands taxes and RMDs, make sure you call us today.
J. Hagan Capital is where you can connect with Jon and his team. RetirementSolutionShow.com is our website. If you have questions about required minimum distributions, Roth conversions, and how all of this affects you and your retirement and what of your money you're going to have to give over to the government, working to help you keep more of that money is the goal of Jon and his team, and they are ready to show you what they can do for you as well. RetirementSolutionShow.com is our website. That's where you can go to begin the conversation with Jon and his team. We also have links posted in the show notes. Lots of folks with lots of questions about taxes, Jon, but here to help you get some solutions and hopefully do the good work of helping you keep more of your money. That's what we're here for. So again, it's RetirementSolutionShow.com.
Thanks for listening to the Retirement Solution Podcast with Jon Hicks. Begin the conversation about your savings plan with Jon and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to Jon's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 1882794.